After a red-oriented futures session on Good Friday, it's fair to ask, will the labor report take down the bulls? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This week's video will put some context around these comments made on short takes on April 1st, 2015. We'll provide a couple of examples of hard evidence on the slowing momentum front and then move on to charts that relate more to price. Regular viewers know that when Williams percent R on the weekly chart of the S&P 500 drops out of overbought territory, we can see this, it's observable. After that, the probability of bad things happening increases. We have dropped out here and we have relatively weak momentum, at least relative to overbought. We're still above negative 50. Typically, very bad things only happen below negative 50. So this is an observable shift that we can see, and it tells us to be open to further weakness until we see observable improvement on this front. Same comments apply to the weekly chart in terms of momentum. Also note, the NASDAQ is still above an upward sloping 22-week moving average. The probability of very bad things happening increases when you start to congregate around it and the slope rolls over. We don't have any of that now, and this speaks to a relatively healthy trend compared to this period here. This is the long-term chart of the NYSE composite that we've been using in these videos for some time. Resistance in 2007, resistance here, resistance here. We get a bullish breakout above this level here, support, support. Based on the futures on Friday after the labor report was released, how might this chart look if the NYSE composite drops the same level that the futures dropped on Good Friday? The answer is not too bad. The futures fell a little less than 1%. That would put this NYSE composite at this level here where the pink line is. And there's nothing particularly alarming about hitting this level here. That doesn't mean that's where the NYSE composite will open on Monday. We don't know that. It's just a reasonable approximation to make for planning purposes in terms of how the futures acted on Good Friday. Taking the same concepts and moving them to a daily chart of the NYSE composite stock index. These lines here were lines that we drew before this breakout. Why do we still keep them in our chart list? They're still good reference points for us. As you can see, we're still making a series of higher lows. This was a bullish breakout here. And on Friday, April 2nd, we were still above this breakout level. How might this chart look on Monday morning? The answer is a little bit more concerning, but not particularly alarming. This would be the level here where the pink line is. You can see for the most part, we would still be holding these breakouts here. We would still be above the 125-day, and we would still most likely be above the 200-day. So not a crisis here. We still have several layers of potential support in here. Our concerns would increase if we move really into this level here. Each level that we break here is more concerning, but we can get into this white space here and eventually make a lower low, which could be paired with this lower high, then our concerns absolutely would increase. Right now, this doesn't look too bad. Same concepts, we're just using closing prices in this case to give ourselves a different reference point. And this is our back of the envelope projection of how things might look on Monday morning. Shifting gears back to the slowing momentum theme. These are moving averages that we use each week. These are weekly charts of the S&P 500. A full bore bullish look as price above both moving averages, blue above red, and the slopes of both are up. Full bore bearish is pretty much the mirror image of that. You can see we've moved back to a full bore bearish look, but we're still in a series of whipsaws on this time frame here. But no question, the close as of Friday, April 2nd is more concerning than the close that we had, let's say, here. This is telling us to keep an open mind about further downside. Support on this chart comes in somewhere in the neighborhood of 2,000. If we extend the time frame out to reduce the whipsaws a little bit, we can also talk about an important point for our time horizon. On our longer and investment time horizon, we're willing to be wrong for short periods of time. For example, we don't particularly care if we're wrong for 3 to 6 days or something, but we don't want to be wrong for 3 weeks or 3 months or 3 years. And the trends and the charts and the data and the evidence and the model help us stay on the right side of things and not make big mistakes. If you can minimize big mistakes, that's more than half the battle in terms of compounding your capital. You can see that this chart looks a lot more like a full-bore bullish look than it does a full-bore bearish look. Bearish look, the dotted or slowest moving average is on top. Here it's on the bottom. Here the fastest moving average, the blue, is on the bottom and its slope is down. Here it's on top and its slope is up. Here it's on top and the slope is up. The point of the exercise is, even if this chart morphs into something that looks more like this, it tells us that we have time to make incremental changes, and it will help us avoid something like this, at least from a probabilistic perspective. Net bottom line, this does not look too bad as of the close on Thursday, April 2nd, or we could even say Friday, April 3rd, since the markets were closed. Checking in on a few more reference points the market model uses. Risk on stocks relative to risk off bonds. You can see this is concerning on a weekly basis and has now made a lower high and a lower low and has a full bore bearish look. The NASDAQ starting to look more concerning. Market breadth as of the close on Thursday, April 2nd did not look too bad. This is the percentage of stocks in the NYSE composite above their 200-day moving average. Here's a chart we put together last week before the labor report was released, and it's as of the close on Thursday, April 2nd. You can see support, support, support. Here's a lower high here, and this is a lower high relative to this high. If this is a downward sloping trend channel, we might come down into the 20-30 area, which also intersects with this line here. There's potential support right around 2,000 if this line were to hold. So we'll keep an open mind. What would this chart look like potentially on Monday morning? Nothing disastrous, but a little more concerning here. If we were to close here at the pink line, that means now we would have made a lower low relative to these closing lows. It's really this low that we'd be more concerned about. But this is starting to look more concerning here, and it tells us that over the weekend we should put together our contingency plans in case we end up somewhere down here in the next 5 to 10 trading sessions. This is a weekly chart. The main takeaway is if we had a close next week, so next Friday at 4 p.m. Eastern Time, if we were below 2050, our concerns would increase. If we remove price, we can see via the evolution of these trend channels two things. The slowing momentum, slopes are starting to roll over, and the potential for a trend change. Slope is up, slope is up, slope is down, but we're not quite at this point. Why? We haven't come down to confirm this trend channel. So if we do, it's further evidence, especially if we break the green line and the pink line on a closing basis next week and close below 2060, then you're starting to see visual evidence of a potential trend change from a bullish trend to a bearish trend. We won't extrapolate, anticipate, forecast, or predict Why? There's no rule that says price has to come down here. Price very well may stabilize and move on to higher highs here. We'll keep a flexible, open, and unbiased mind. If we close down here, we close down here next week. If we don't, we don't. Weekly S&P 500 point of the exercise. This slope is in the books. Markets tend to like symmetry, so therefore these orange lines may act as potential support. These levels here in green, denoted by the dotted and solid blue lines, are the most important on a weekly basis. If we close below 1985 in this area here, our concerns would increase and the market model would force us in terms of the rules to reduce risk fairly significantly and fairly rapidly. We're looking at the same chart here. We've just added in the Fibonacci retracement levels from the October low on a closing basis on the weekly chart to the high here in February. Why do we look at so many different sources of potential support? It's because the market will decide what's important. It has nothing to do with what we believe is important in advance. Let's say the market comes all the way down to 1972 in 3 weeks, and we drew this line 3 weeks prior, and we review this chart. It would tell us, rather than panicking, that we might actually be at a point where the market might reverse itself. So planning way in advance, weeks and months in advance, can pay big dividends when you pull the chart up and say, is there a basis for patience here? And if we move into these areas here, the answer begins to float towards the direction of no, there is not a basis to be patient. Again, on this chart, interestingly enough, our futures projection would take us right down to these orange lines here. Same concepts, we're just using high-low close to calculate the fibs from the October low to the high here. The 61.8% retracement of this move would take us to 1934, which could be potential support. The back of the envelope projection for where we might open Monday would coincide with this dotted trend line here, meaning we may open somewhere near potential support. Daily S&P 500 fibs closing prices, October low, high here, 61.8% retracement is at 1959, 50% 1989, 38.2% at 2020. This is a good time to review how the fibs help us. What these Fibonacci retracements tell us is that when we move from this point here to this point here, it is normal within the context of an ongoing uptrend to retrace to this level here, here, or here. And what does that mean? That means it would be normal to come all the way back down potentially to 1959 and then resume the existing trend, which is up, which would imply that we would go on to make a higher high. How these help us? As long as we stay above these levels, the odds of the uptrend continuing are higher. When we start to break below these levels, the odds of a trend reversal start to increase. Daily S&P 500, these are the fib levels based on this low in February, this high in late February, potential support. What does our futures projection look like? The back of the envelope projection takes us right into an area or cluster of possible support, telling us to keep an open mind about what will happen on Monday, especially if we get a weak open. It's possible that if we close somewhere in this area here, that we could then bounce back on Tuesday. A close down here would lower the odds of a bounce back. Not eliminate, but lower. Now we're looking at closing fibs based on this low here in December and this high here in February. These levels also tell us to keep an open mind about what happens early next week. Potential support at 2044, back of the envelope Monday projection at 2047, which is also above this dotted line here, and it's also above 2027. Some other reference points for the market's tolerance for risk. This is shorting small caps RWM relative to SPY. It's clearly in a downtrend. The same ratio broke into an uptrend 3 months before the stock market peaked in October of 2007. Similar situation to give us a reference point for fear. We're looking at the weekly VIX. You can see fear was spiking here in 2007, well before the stock market peaked. The VIX ramps up and makes a higher high here months before the stock market peaks in here. That's not what we have today. The same VIX chart has not made a higher high like this for 5 months. Weekly small caps IWM in isolation as of the close on Thursday, April 2nd. Full bore bullish look, quite a bit different than the peaking process in October of 2007. Again, this tells us that we would have time in most cases, or at least from a probabilistic perspective, to migrate away from risk. We can see this. This is an observable change that occurs in October of 2007, well before disasters start in the stock market. Did we see a discernible change in this breadth chart that we've been following? No, we're still making a higher high here as of the close on Thursday, April 2nd. Quite a bit different than the look here in October of 2007 when the stock market peaked. We wrote about triangles on short takes. This was the chart that we posted earlier in the week. This is the version as of Thursday's close. Here's our projection, so we're not really violating the triangle at this point. If we moved into this area here, our concerns would increase on a weekly closing basis. To summarize, our game plan really has not changed. We've been talking about potentially reducing risk in an incremental fashion if we saw a close below 2039 and or 2045 on the S&P 500. We've been saying for weeks that these levels down here are more important. If we move into this area here, we would have to move away at a much, much faster rate, especially if we're in this area here at the end of a week. The same is true here. It becomes more important if we close in this region here at the end of a week. Intra-week here is not as important because we could bounce back. This is the same chart with our futures projection. And what does this tell us? It tells us that if we closed, let's say the S&P 500 was open on Good Friday, and we closed at the same level the futures closed at, it tells us that we would have closed right on this dotted trend line. We would have closed at 2047, which is above 2039 and above 2045, and therefore we still would have tried to remain patient within the context of the rules. Not much has really changed from a risk management perspective. The game plan remains the same. The only difference really is we can't emphasize enough. If this breaks down, we will have to reduce risk quickly. How do we decide how quickly to reduce risk? The answer is we don't decide. The market model, via the hard data, facts, and evidence, decides. The main thing the market model does for us is tell us a prudent exposure to conservative assets in percentage terms and a prudent exposure to growth assets in percentage terms. So if we break down, the evidence tells us how quickly we have to move away. We move away at a rate that's in line with the rate of the deterioration of the observable evidence and facts. It has nothing to do with fear or our personal opinions. As always, we'll head into next week with a flexible, unbiased, and open mind. The market, the facts, and the hard evidence, and the market model will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.